In March 2026, a severe geopolitical shockwave struck the Strait of Hormuz, immediately paralyzing global maritime supply chains. The energy chokehold at Hormuz has fractured global correlations, separating the performance of oil importers from the energy-rich exporters. Right now, global indices are attempting a structural recovery based entirely on whispers of fragile diplomatic backchannels in the Gulf. But that temporary relief rally is colliding with the restrictive reality of the U.S. Federal Reserve. The FOMC, the Federal Open Market Committee, which dictates U.S. monetary policy, is convening for a critical two-day meeting. Capital is currently paralyzed. Institutional players are caught directly between the easing of the Hormuz blockade and the threat of an aggressive Fed rate decision. To find alpha in this chaotic environment, you have to map exactly how $100 oil fractures specific regional indices. Regional performance is no longer synchronized. It is entirely dictated by a nation's baseline energy dependency and its central bank's flexibility to respond. We start with the U.S. market, where the S&P 500 is attempting to defend structural support at 6,650 amid heavy volatility. A temporary drop in geopolitical fear has allowed capital to rotate aggressively out of cash and back into large-cap technology and consumer staples. This chart shows the S&P 500 ignoring underlying data. The NY Empire State Manufacturing Index plummeted to negative 2.5. This contraction confirms energy pressure is suffocating industrial output. Technically, it must reclaim 6,780 resistance to invalidate this head and shoulders pattern. If Chair Powell steps to the podium and refuses to label the $100 oil shock as transitory, this fragile technical structure will collapse. The U.S. market is a hawkish trap. Failing to hold 6,600 triggers an algorithmic liquidation wave, dragging the index down to the 6,400 floor. Moving to Europe, the DAX index is projecting a deceptive resilience, ending recent sessions near 23,564. The German export machinery received a brief tactical boost from China, which posted a better-than-expected 6.1% increase in industrial production. But imported energy inflation remains the ultimate earnings killer across the Eurozone. This dynamic pie chart shows European sector breakdowns. Hypersensitivity to Hormuz transit costs is devastating energy-intensive sectors, physically compressing the market share of chemical manufacturing and heavy engineering. Simultaneously, the European Central Bank maintains a hawkish stance to fight imported inflation, heavily penalizing rate-sensitive sectors like utilities and real estate.
Any upside on the DAX is capped at 23,800. To survive the threat of industrial energy rationing, institutions are hiding capital in defensive healthcare allocations. In the Asian session, the Nikkei 225 has reclaimed the 54,000 mark, surfing the global bounce in risk appetite. The index has a rare internal catalyst pushing it higher. Japan just recorded its first real wage increase in 13 months. However, that domestic victory is entirely offset by an exploding yen-denominated oil import bill. This line chart tracks intervention anxiety. The USD to yen exchange rate aggressively tests the critical 158 level. The Bank of Japan is an absolute policy deadlock. They cannot raise interest rates to defend their currency without crushing an economy highly sensitive to energy prices. The Nikkei is hostage to dollar strength. Failing to breach 54,500 resistance risks a massive wave of liquidation down to the 50,000 floor. While Western and Asian markets struggle, the Saudi TOSI is exhibiting massive structural outperformance, decoupling completely from global growth scares. The energy supercycle provides the kingdom with a massive fiscal cushion, rendering the TOSI the ultimate stagflation hedge for global portfolio managers. But the most significant decoupling anomaly is occurring in India, where the Nifty is displaying extreme structural resilience. The Indian market is currently the battleground for a massive internal capital war between foreign and domestic liquidity. This flowchart illustrates FII capitulation. Foreign institutional investors executed severe cash net exits, totaling negative 4,741 crores. But look at the immediate absorption. Domestic institutional investors injected a massive 5,225 crores, completely neutralizing the foreign flight. Despite this domestic floor, the derivatives market reveals a severe ceiling. Traders are heavily engaged in call writing at the 24,000 level. Call writing is the act of selling call options, indicating sellers confidently expect the price to remain below that specific strike.
This massive absorption by domestic institutions is currently shielding the Nifty from the capital flight typical of emerging markets during an oil crisis. Across the globe, capital is operating under strict defensive selective parameters. While the Gulf headlines drive short-term volatility, the volume of global dollar liquidity will determine the trajectory of capital through the second quarter. All institutional eyes are fixed on the Federal Reserve's exact wording regarding balance sheet normalization, the process of the central bank reducing its asset holdings to tighten the money supply and cool down the economy. Until the Fed provides a definitive path for 2026 liquidity, smart capital will remain safely parked in defensive havens. For the next 48 hours, professional trading dictates strict quantified risk parameters and highly reduced position sizes. This minimalist dashboard displays the exact numerical fail-safes for the current market structure. The absolute technical floor for the S&P 500 is 6,600, and the equivalent structural fail-safe for the Indian Nifty sits exactly at 22,900. A daily close below either of these critical floors confirms a structural shift into a global bear market. Manage your risk accordingly.